Your credit score is one of the most powerful numbers in your financial life. It influences how much you pay for a mortgage, a car loan, or even a credit card. Yet most people never learn how it actually works. Today we're going to break down the credit score step by step so you can understand it, control it, and use it strategically. 1. What a credit score really is. A credit score is a 3-digit number, usually ranging from 300 to 850, that represents your credit risk in the eyes of lenders. It's not about your worth as a person. It's a tool lenders use to estimate how reliably you will repay borrowed money. Think of it like a performance report for managing credit. Pay on time, positive points. Max out cards, negative points. Keep old accounts open, positive points. Open too many new accounts, negative points. Your credit score is one of the most powerful numbers in your financial life. It influences how much you pay for a mortgage, a car loan, or even a credit card. Yet most people never learn how it actually works. Today we're going to break down the credit score step by step so you can understand it, control it, and use it strategically. 1. What a credit score really be? Credit utilization 30%. This measures how much of your available credit you are using. Example: if you have $10,000 in credit and use $3,000, your utilization is 30%. Rule of thumb: keep it below 30%, ideally below 10% for the highest scores. C. Length of credit history 15%. The longer your accounts have been active, the more reliable you appear. Example: a 10-year-old credit card is better for your score than a new one. Tip: avoid closing old accounts unnecessarily. Your credit score is one of the most powerful numbers in your financial life. It influences how much you pay for a mortgage, a car loan, or even a credit card. Yet most people never learn how it actually works. Today we're going to break down the credit score step by step so you can understand it, control it, and use it strategically. 1. What a credit score really is. A credit score is a 3-digit number, usually ranging from 300 to 850, that represents your credit risk in the eyes of lenders. It's not about your worth as a person. It's a tool lenders use to estimate how reliably you will repay borrowed money. Think of it like a performance report for managing credit. Pay on time, positive points. Max out cards, negative points. Keep old accounts open, positive points. Open too many new accounts, negative points. 2. The 5 key. 4. The real value of a high credit score. A higher score translates directly to lower interest rates, saving you thousands over time. Example: 2 people buy a $400,000 home. O person A. Credit score 780, 5% mortgage rate. O person B. Credit score 640, 6.5% mortgage rate. Over 30 years, that 1.5% difference could cost person B over $100,000 extra in interest. Your score isn't just a number, it's a financial tool. Knowing how it works gives you control over your future payments. 5. Actionable steps to improve your score. 1. Pay bills on time, the most important factor. 2. Lower credit card balances, reduce utilization ratio. 3. Keep old accounts open, build history. 4. Diversify credit types, responsibly manage multiple accounts. 5. Limit new credit inquiries, only apply when necessary. 6. Key takeaway: your credit score is a tool, not a trap. Understand it. Manage it. Use it to save money and access better financial opportunities. When you treat your credit score as a resource instead of a judgment, you gain freedom, not restriction. How mortgage rates work. Mortgages are one of the most important financial decisions most people make in their lives. The interest rate you get can mean thousands of dollars saved or spent over decades. Understanding how lenders calculate rates gives you the power to make smarter choices and keep more money in your pocket. 1. What determines your mortgage rate? Lenders look at several factors to determine the interest rate they offer you. 1. Credit score. Higher scores generally lead to lower rates. 2. Down payment. Larger down payments reduce lender risk, resulting in better rates. 3. Debt-to-income ratio, DTI. How much of your income is already used for debt? Lower DTI equals better rates. 4. Loan type and term, fixed rate versus adjustable rate, 15-year versus 30-year mortgages. 5. Economic and market conditions, inflation, Federal Reserve rates, and overall economic health. 2. The impact of your credit score on mortgage rates. Credit score is the most visible factor. Example, $400,000 home, 30-year fixed mortgage. Person A. Credit score 780, 5% interest, $2,147 per month. Person B. Credit score 640, 6.5% interest, $2,528 per month. Over 30 years, Person A pays approximately $772,920 in total interest. Person B pays $910,080 in total interest. That's a difference of $137,160 just because of credit score. This shows how strategically managing your credit directly impacts your long-term wealth. 3. Understanding debt-to-income ratio, DTI. DTI equals total monthly debt payments divided by gross monthly income. Ideal DTI for lenders is less than or equal to 36%. Lower DTI equals lenders see you as less risky, which leads to a better rate. Tip: pay off high-interest debt before applying for a mortgage to improve your DTI. 4. Loan type and term. Fixed-rate mortgages. Interest stays the same for the entire term. Predictable payments. Adjustable rate mortgages, ARM. Lower initial rates can increase over time. Riskier if rates rise. Shorter terms, 15 years. Higher monthly payments, lower total interest. Longer terms, 30 years. Lower monthly payments, higher total interest. Tip: choose a term and type that balances monthly cash flow with total interest paid. 5. Down payment strategy. Standard, 20% down avoids private mortgage insurance, PMI. Smaller down payments, higher interest or PMI required. Tip: even a small increase in down payment can reduce interest paid over decades. Example, $400,000 home, 20% down, $320,000 mortgage, $10,000 extra down, $310,000 mortgage, lower monthly payment and interest. 6. How to save thousands on a mortgage. 1. Check your credit score before applying. 2. Shop multiple lenders. Rates can vary significantly. 3. Consider paying down high-interest debts first. 4. Make a larger down payment if possible. 5. Understand all fees and closing costs, they add up. 6. Avoid opening new credit accounts right before mortgage application. 7. Key takeaways. Mortgage rates are not random. They're based on measurable factors: credit, income, debt, and down payment. Small improvements in your financial profile can save tens of thousands of dollars over time. By understanding how mortgage rates work, you can make smarter borrowing decisions and avoid unnecessary financial stress. Financial freedom and smart money strategies. By now you understand your credit score and mortgage basics, but the real goal isn't just a good score or a low-interest loan. It's financial freedom. Financial freedom means having control over your money, your choices, and your time. It's about making decisions that build long-term wealth rather than just paying off monthly obligations. 1. Understanding smart borrowing. Borrowing isn't inherently bad, it's a tool. Borrow wisely. Use debt to invest in assets that grow in value: home, education, business. Avoid high-interest consumer debt, like unnecessary credit card balances. Practical tips. 1. Use credit cards responsibly. Pay full balance each month to avoid interest. 2. Take loans only when the long-term benefits outweigh the costs. 3. Always consider the total cost of interest over time. 2. Managing mortgage strategically. Owning a home is an important step, but it doesn't automatically equal wealth. Strategies. Consider your loan term carefully. Shorter terms save money on interest. Extra payments toward principal can save tens of thousands in interest. Refinance only if rates are significantly lower and closing costs make sense. Example: $400,000 mortgage, 30-year fixed at 5%. Paying $200 extra per month toward principal. Saves 7 years and approximately $50,000 in interest. 3. Building wealth outside debt. True financial freedom comes from assets that grow. Key areas. 1. Investing in education and skills. Increases income potential 2. Retirement accounts, compounding over decades 3. Low-cost index funds, or ETFs, long-term growth 4. Emergency fund, 3 to 6 months of expenses. By balancing borrowing, saving, and investing, you control your money. It doesn't control you. 4. Breaking the cycle of debt. Even responsible borrowers can fall into a cycle of debt if they aren't strategic. Best practices. Avoid borrowing for lifestyle inflation. Don't rely on future raises to cover current spending. Review your finances quarterly. Track spending, savings, and investment growth. 5. Action plan for financial freedom. 1. Understand your credit, know your score, and how to improve it. 2. Plan mortgage wisely. Loan type, term, down payment, DTI 3. Use debt as a tool, not a trap. 4. Invest consistently. Retirement accounts, index funds, skills 5. Protect your future, insurance, emergency funds, budgeting to well. 6. Key takeaways. Financial freedom is not about avoiding debt completely. It's about using financial tools intelligently. The most powerful financial asset isn't your house. It's your knowledge and strategic choices. By focusing on education, smart borrowing, and investing, you gain peace of mind, control, and long-term wealth. Understanding your credit, mortgage, and money strategies is the first step toward true financial freedom. Don't chase a number. Build value instead. Control your finances before they control you. Apply these strategies consistently, and you'll see real results. If this guide helped you understand your finances better, share it with someone who could benefit, and subscribe to learn more actionable strategies for building wealth and mastering money.